Welcome. So I haven't done this presentation by webinar before. It's a little bit different, not getting actual feedback from the audience as we go, but hopefully it is useful for you. A bit of context for you as to my role and where I work and why these insights are relatively available to us. I work at NavTrade, which is an online broker. It's NAB's equivalent of Comsec, the easiest way to explain it. And as you'll gather from the presentation, and you may already know, online brokers are very much a core competition for SMSF. So around 90% of SMSFs will have some kind of online broker relationship, which may surprise you. We see huge proportions of our client base either transacting only through their SMSF, or they have a personal account and they'll have an SMSF account as well. So we look at this group so you'll appreciate I worked with advisors for many, many years. I worked in technical, primarily started off as a paraplanner, worked in technical services for a very long time. I ran the technical team at MLC for many years before I moved into this role. And it's been very interesting transitioning from an advice role to a self-directed role, so working with investors who want to do their own thing and have not been choosing to get advice. Also been really valuable being able to take the insights you get from that group of investors back to advisors to say, look, there's this whole group of people out there who want to do it themselves, but they do need advice in many cases, and here's what they're looking for. So that's the context of the presentation. To a bit of a market overview, you may have seen some of this data before. You may not have. Some of it, it's very expensive to acquire through some of the research companies, and when you're in private practice, it's pretty expensive to get access to this kind of stuff, so hopefully it's useful to you. The ATO data is publicly available. You can get that yourself from the ATO website. Sometimes it's a bit tedious sitting there calculating all the percentages of everything. And then also give you some insights about what we see from investor behaviour. We have literally millions of logins every month on the NavTrade site. So we get really, really good data on what our investors are doing because they log into their own account as well. We can see whether they have an SMSF and see very clearly what type of investors they are, their age groups and all those sorts of things. As context, SMSFs comprise about 7% of our total customer base by number. They are somewhere between 35 and 40% of deposits in assets and trading. So they massively over-index relative to the average investor. You know that anyway, right? So you know for your clients, your SMSF clients are often your best. So to talk about the market in summary, you would have seen a lot of this data before. Everyone loves talking about it. There are nearly 600,000 SMSFs in Australia at the moment. This is based on the most recent data from the ATO. So this is the statistical report that came out in March 2019. It's always a little bit delayed. Total number of members is a bit over 1.1 million. Assets, 7.15 billion, is that right? No, it's quite a bit bigger than that. Anyway, they are about a third of the market. This is the critical thing. They're about a third of the total superannuation market. The critical thing is, and again, this is something that advisors are aware of, but worth mentioning because a lot of people in big institutions find this surprising, over half of all pension assets in Australia are in an SMSF. So if you have enough money to start a pension, you are probably thinking about an SMSF. Most people who don't have enough money in super to start a pension, we know average balances are less than $200,000 at retirement, which means for many people a pension is just not viable. They'll take it out and put it in term deposit. They won't bother with starting a pension. If you're thinking about starting a pension, you are probably thinking about an SMSF, and that is whether you are a self-directed investor or whether you are going to go and get advice when you do it. Everyone loves talking about that data. Critical thing is it's not a homogeneous universe, so there's a really wide dispersion of SMSFs in that group. There is a small group of SMSFs that have enormous balances. Critical thing is this has changed a bit since the introduction of the transfer balance cap. That cap has obviously impacted those $100 million SMSFs that you may have heard about. There was a handful of those. For them, there's been a bit of a shift. So the data has moved a bit on this, but generally speaking, the high balance SMSFs drag up the average. So the average balance is over 1.2 million, but the median's not quite 700. There's a lot of small SMSFs and a lot of really big ones that drag up the balances. Changed a little bit since 1 July 2017 though. The universe that they can invest in, so moving through the sort of contextual stuff quite quickly. The universe of what they can invest in, you guys know this stuff. The critical point is that what they invest in is totally different. Now these are last year's figures. They don't move around a great deal. So you would like to believe this is going to change. It doesn't. It's from the ATO. There's a bit of conjecture and argument, I would say politely, about the validity of some of these numbers, primarily because this is effectively what accountants put into the tax return or administration firms put into the tax return of the SMSF. And therefore, some things may look a little bit different to what you and I would understand them to be. So managed funds are classified by the ATO as other unlisted trusts. The reason I put private trusts as 11% is there is also a category called unlisted trusts. A lot of people think that's managed funds. It's not. They are private trusts. Many of you who are older would be aware of the pre-99 unit trusts that could be held by SMSFs. Also those arrangements that SMSFs have to buy property through a unit trust. That's what that 11% is. So it is not generally available to advisors and other groups. It's a more sort of complex component of SMSF that were established quite some time ago for specific. The really obvious thing that people hold a lot of is listed Australian equities and cash and term deposits. So listed stuff, for want of a better term, listed equities, listed trusts and so on comprise an enormous proportion of SMSF portfolios. And that has been pretty consistent over time. It doesn't change dramatically. The other one that tends to surprise people is that commercial property is much larger than residential property. So despite everything that you've heard about the growth of LRBAs and so on, residential property is always a much smaller proportion of SMSF holdings than commercial because of the arrangements that apply to business real property. So there are very specific reasons why people would set up business real property arrangements, and they would sometimes borrow to do it, which is quite attractive. This is all stuff you guys know, so when I'm talking to institutions and I'm talking to people internally, some of this is unfamiliar. All of you guys will be aware of the strategies that apply and why these asset classes fall out the way they do. Now, one thing you will be aware of is that advised portfolios do look really different. This is the average portfolio, right? So across those 600,000 or 700,000 funds we've got out there, 600,000 funds, this is the average of all of them. So when they get a full return for every fund every year and they average it all out, this is what it looks like. If you look at a subset of those that are managed by financial planners, it looks really different. The reason is you guys all understand diversification, and there is a clear allocation to fixed income, which is obviously not in that group, right? Cash and term deposits is the proxy for fixed income for this group, and also for international equities, which is very poorly represented. So that 1% in overseas shares, again, contention and conjecture about that number of 1%. If any of you read Cufflinks, Graham Hand likes to get fired up about this one. Usually me personally. I know Graham, he's excellent, and Cufflinks is a brilliant publication, but it's quite funny. He gets quite concerned when people say that overseas shares is only 1% and he thinks the ATO data is incorrect. However, even if you break down the managed funds component and assume that there's a significant proportion of international equities, you look at other assets, you look at private trusts, if you assume some of the listed shares might be a platinum LIC, for example, even if you add up all those other things, about the maximum you could come up with that is exposed to international equities is about 10%. So it is still well below the average that a financial planner would use in a balanced portfolio. So these guys have a totally different asset allocation to what the standard advised client would have. I haven't put any data in this presentation about portfolio performance. There is some good data. It's not perfect, it's good. That shows the performance of the average SMSF versus the average retail fund or the average sort of managed portfolio via a super fund. They did really well for many years. So period leading up to about 2009-10, SMSF were killing it. They actually outperformed most of the major funds in Australia and certainly the average APRA fund, which is quite extraordinary when you consider their mums and dads. Since then, they have trailed. And the primary reason they've trailed is they've had a lot of cash and term deposits and they haven't had a lot of international equities. So that incredible performance of the S&P 500 in particular, and if you had a tiny bit of exposure to the Indian market, for example, they've missed out on a lot of that because they haven't had that exposure. Again, this may be stuff you're familiar with. One thing that surprised me when I updated this presentation, the talk about LRBAs has died right down, partly because property prices have gone mental and it wasn't feasible for a lot of SMSF to be able to afford them even with borrowing. The other reason is that all the major lenders have exited this space. So I work at NAB. We do still offer it for very, very, very special clients. It's very unusual to see these offered by banks now. So I had assumed that the proportion of SMSF borrowings would have dropped. They're still in the data is always delayed, rising a little bit. So 5.6% of total assets. It's a huge number in dollar terms, but it's not growing in the way that we anticipated it will continue to sort of grow earlier on. APRA restrictions had a bit to do with it. Most of the banks just avoided it after a while because there was a fair bit of risk in it. A lot of investors did not understand the rules around having property inside an SMSF. Bit of people moving into it and all that kind of stuff. So let's talk about this segment. The data I have here is from Investment Trends. They take a survey of about 5,000 SMSFs. It is an online survey. They ask the primary decision maker from each SMSF and they collect this data annually. It's never going to be perfect, so if you're not comfortable with some of the things that are in there, just remember it's an online survey. They are self-managed super funds, so they do testing at the beginning of the survey to ensure that someone is correctly answering whether it's an SMSF or a different type of fund. And the response comes from the primary decision maker for the fund. You would know that most funds do have a primary decision maker. And over time, there's thousands of questions in this thing, really good quality data to the best that you can get it, right? For a universe of 600,000 funds, 5,000 is the sample size. It's 5,000 people who are happy to answer an online survey. What is really important to take from this is that the proportion of SMSF trustees who define themselves as delegators is low. It has been consistently lower than 10%, and it has dropped really significantly in the last 12 months. So SMSF trustees, it's not just the NAB trade experience, is probably what I'm trying to tell you. They consider themselves to either be self-directed or this idea of a validator. So this idea of a validator, which is, I like making my own decisions, but I'm really happy to go and see a financial planner if they can offer me something I can't do myself, or they can confirm that I'm on the right track. So there's three reasons why they consider themselves to be validators. One is they use an advisor for a second opinion. Secondly, they are looking for access to a wider range of investments than they can access themselves. And then also they're looking for technical skills. You will see there was a bump on that in 2017-18, which was around the time of the introduction of the cap, right? So when there's a big technical change, you will see a spike in those people who want more advice. But it started to fall away again as people get comfortable with the changes. There has also been a very significant increase in the last 12 months in the group who say they won't use an advisor. The one that's interesting there is because I can make better investment decisions. Now that one, you can't see it in this chart because it doesn't go back far enough, but there is absolutely data to support it from this same survey, is usually driven by adverse market movements. So there's also been a decline in the number of establishments of SMSFs, which has been pretty widely reported. The peak was about 42,000 a year, and now we're back in the low 20s. So it's almost halved, which is pretty amazing. I can absolutely guarantee you if we had a really bad year in the markets, and that will happen eventually, and people start getting statements saying that their balance has actually decreased over time, they will start establishing SMSFs again. So that's the biggest driver of establishments is poor market movement, and the piece of feedback people give, and they use it verbatim, is, I'm not going to pay you to lose my money. So I will lose my own money, fine, but at least it was my own fault and I didn't pay you for the privilege. It's kind of amazing the psychology behind it, but it's shown up consistently throughout the data over the years that people will look to do it themselves because they don't like paying to lose money. This point about people at the top who would use an advisor because they're not comfortable making investment decisions has dropped a lot. Now, that may have been because markets have been really strong and everyone feels like they're making great decisions because they're making money. So we'll see what happens when markets change. Here's what we see on the NAB trade side. First thing, people are, in this category, unbelievably engaged with their portfolios. Now, obviously, we have a unique subset of investors. If you're going to go and set up an online broking account, you are going to log in and find out where your funds are invested. You are going to be the ones making the decisions. But the number who log in regularly is very high, much higher than the average investor. They are very much looking for opportunities beyond equity. As I said, they're hugely overweight listed Australian stuff, so primarily equities, but also hybrids, LICs, ETFs, ETMFs, and so on. They are looking for broader investment choice. They know that they're very concentrated in their portfolios. They are also, and you know this, absolutely hurting with the drop in rates. They know that term deposits are not going to pay for their retirement, so they are trying to think of ways to get yield that is not going directly just with a deposit. So we've seen significant increases in M funds. We've seen significant increase in direct international. So through NAB Trade, you can buy direct international shares. If you want to go and buy Amazon, you can buy it directly. And the brokerage is the same. So that's been quite appealing to this group. ETFs, they buy that story, right? They get it. They're very comfortable with ETFs and they read a lot of the content that we have about it and so on. The piece of data that surprises a lot of people. So there is this assumption about lack of engagement among clients. That is not our experience at all. So the strongest rating video at the time, and this was without a headline act, without any kind of fancy anything, and the context on the timing is I'd just come back from maternity leave and it turned out we'd published nothing on the super changes. I was like, we've got to publish something. What are we doing? So we published a video about the super changes on the 22nd of December. The general assumption is that everybody's on holidays and no one is checking their portfolio. That was not our experience. So what we found was all of our SMSF trustees were watching this video because they wanted to understand the changes and what it was going to mean for them. And also they had the time to do it. So a lot of the general assumptions about what people are interested in, how engaged they are, and when they're available is changing. The other thing that we have also noted recently is the most significant period of log on, apart from trading hours, is Sunday morning. So none of us are working on Sunday morning, I'm telling you. But it is worth thinking about whether or not your website, your content is working on Sunday morning, because that is when these trustees are logging in to find out what they can learn. Here is where SMSF trustees are saying they would like to be receiving financial advice, but are not. The one that surprises people is inheritance and estate planning. So pension strategies has jumped quite significantly because of obviously the changes that really are affecting a lot of people. We always see investment strategy, underlying assets, undervalued assets and so on, protecting assets against market falls has really, really jumped, which is interesting, and also investing for regular income, so that has jumped quite a bit. It's pretty consistent, that line there. You can see there's a lot of numbers that have jumped quite significantly, and the average number of areas that people are looking for more insights and more advice has really increased. So it's gone from 2.1 a couple of years ago to 2.8. There are more things that people need help with, which is a good thing. Estate planning and inheritances is one that I personally get a heap of questions about when we do presentations and so on. The number of people who want to know about it. I think you reach a critical mass of assets and then you start worrying about whether or not your kid's going to blow it all. So that seems to be the question that I get most frequently. The other thing is that the no, I don't need any help has dropped a lot, very significantly over the last few years. So people do know they want advice. The critical thing is, how do you ensure they know they can get it from you? few latent risks, again, things that will not surprise you. In 2017, so this is a little bit old, but it won't have changed dramatically, about 14% of self-managed super funds had at least one member who was going to be affected by the cap. That's a reasonable number. About a third, a bit less than a third, were going to be affected by the reforms in 2017. That has washed through, but obviously anyone who is transitioning into retirement, and I don't mean it in the strategy sense, I mean they are retiring, those people are thinking about the impact of those reforms. They're now BAU, but they need to have a strategy to work around it. So the concentration in equity portfolios is crazy. I can tell you the top 10 stocks in almost every SMSF portfolio on NavTrade because they're very, very predictable. They are hugely underweight in international and fixed income. And the point about fixed income is really interesting. They know that they have underperformed without exposure to international equities, and they are very concerned about the drop in yields from their current portfolio. So both of those things they're not surprising to the average SMSF trustee. They know that. It's just doing something about it. Final thing is estate planning, and this issue about ageing comes into people's minds sort of 70 plus, and we know that this group is in that category. A couple of other comments. Market volatility will drive more validator style behaviour. We will probably do more of that. Accountants don't own the relationship as much as they used to because of this increase in SMSF using administration services, which are much less expensive. Final thing is it's relevant to you as a financial planner is having stuff available online is absolutely critical to this group. They are really, really, really tech savvy. So the middle point that I put here, they are very active online. We see logging in all the time. If you speak to any of the major content providers, they know that this group, the self-directed group of SMSFs, are seeking out content constantly. I would say, with no disrespect to anyone, there are very few financial planners who go out of their way to present themselves as thought leaders on the technical side of self-managed super funds, right? There's a handful and they do it really, really well. But there are so many ways that you can present yourself as the person someone to come to when they've got a problem with their SMSF, a technical issue, whatever it might be. I can absolutely guarantee you that if you were seeking SMSF clients, they will have researched you online before they come to you. There is no SMSF client I have ever met who would not have looked you up before they came. And if they can't find enough information, they may well opt out entirely and go to someone where they can see on the website or they can see a video, whatever it might be, that says, this person knows what they're talking about, there's someone I can trust, they've got information that I can relate to before I go in there and meet with them. They are rate sensitive and they're very active, so they are very conscious at the moment of needing to make as much with their money as possible. Drop in yield, real problem. They are very fee sensitive. They are very thoughtful about cost. They're not great necessarily at assessing value. So that's necessarily, some of them are excellent at assessing value and will take the time to break everything down. They will pay for someone to do the hard work, but you've got to demonstrate that the work has been done and that it was of value to them. Again, I think somewhere where financial planners can really make themselves appealing to potential SMSF trustees or existing trustees is to be really transparent about what things are going to cost, or at least give people an idea so they can assess value in advance, particularly if you couple that with some thought leadership, some case studies, some good examples of where you can add value, and preferably in areas that are really complex that you know they can't do themselves. That, I think, is really valuable. It's not done terribly well. A couple of other things. The top point is not one I make to financial planners, but I do make it to businesses really frequently, which is this group, they're very astute, right? Most of these people are professionals or retired professionals, or they made a lot of money. If you have an average balance of $800,000, you're doing okay, right? You made some good decisions in your life. Be respectful. The idea that they will come in, hand over all their money and just trust you, I think is a bit ambitious. Most of these people are far more astute and engaged than that. They're going to be more critical. The reason that they're going to ask a lot of questions is they always would have done it in their working life and they're reasonably smart about how they spend their money. So they want to know that they can trust you and you have to demonstrate expertise and so on. The second part is that technology is fantastic, right? You can do a video for $700, or if you've got a 15-year-old free, because they'll do it on their iPhone, they'll look better than anything we ever pay for, and do these amazing videos. You can do written content. You can do all of this fantastic stuff. Put it in the public domain to build your brand. I don't see a lot of financial planners doing it at the moment. I think it's a real opportunity, not least if you go back to this slide, and I think, Karen, people have access to these slides.
Yep.
If you go back to that slide that details what areas people are looking for advice on, you can break them down and work out which ones you currently specialise in and articulate what value you're offering in each of those areas.